Hi, Jeff. Welcome to Al Insights, podcast by Momentum Finance for founders and of topics of interest to founders, and I think specifically with an idea of finance and how that can be supportive. And I know that we met a few years ago through Founders and Funders, and we've been pretty active in engaging the local community. For our viewers, how about talk a little bit about your background?
Yeah, absolutely. So, Tim, this is great. Thank you for having me on. First off, but so my background is I actually graduated from the University of Utah with an accounting degree. That is not something I'm like. I wouldn't call myself an accountant. After that, I did an MBA in finance, and that seemed to be more exciting for me than the accounting. But after leaving my grad school program, I ended up at an investment firm and spent about 4 years doing investments. And while I was there, one of the partners left to go to this little startup. And it was called Icono Communications. He took me with him, and I ended up being like employee number 15 at this little startup. And I absolutely loved it. That was like, this is for me. And so that's kind of that was my introduction to startups and that world. We went through the process of raising 3 rounds of pretty decent sized rounds of funding, and I got to see how that kind of works and the whole venture system, and that was just really appealing. Well, after that, I went off and started a company with some friends, and my wife had a hobby that turned into a company that did way better than what we were doing. And so I ended up helping her raise some capital, and this company just kind of took off. And so it was called Uppercase Living, and I ended up helping run that company for about 10 years.
Okay.
We ended up selling it to a private equity group, and they made me stay on for 3 years after that, which was really painful. It was 2 years too long. But during that process is really when I was able to start angel investing, and I wanted to get back into more of the tech startup scene, and that's where I came across a little company called eShares, which later rebranded to Carta, and that was a phenomenal experience just going through that.
And how did you meet eShares?
So I actually reached out on LinkedIn. I was just kind of networking and trying to figure out what do I want to do next. And I remember coming across Carta. First off, I thought, what a cool company. Helping make it so that founders know what ownership percentage looks like in their companies, and being able to track all of that, issuing equity, and really this vision to kind of become the private market of the future.
Well, that is such a pain point for founders, because before eShares came along, if we ever needed a cap table for whatever purposes, we had to call the attorney. They had to update it, check it, confirm it, send it to you. And if you needed another update, you always had to talk to your attorney. There was no way to self-feed the cap table, and that was always a big issue when working with founders, because somebody asked for it, you've got to prep some kind of reporting, and so that eliminated a huge pain point.
Oh, for sure.
And I know that you've kind of tangentially moved up the stack, and now you're working with Forecastr, which is really trying to software-tize the whole financial planning and analysis piece, which is incredibly helpful, because I know we have a couple mutual clients that are using the platform, and the feedback I get from founders is it's so nice to log in and just see the budget, or to actually sit down in a prospective investor conversation and go through the what if, the high, low, medium analysis.
Yep. Yeah, it was really fascinating, because after being at Carta and seeing the pain point that founders had to go through in managing their equity, and taking that out of spreadsheets, your cap table out of spreadsheets and into a software platform that makes it so the founders can manage certain aspects of it. The other pain point I also saw founders dealing with was their financial model. Most founders aren't really good at that, and so I kind of looked at Forecastr as the Carta of financial modeling, right? Making financial modeling easy for founders, and so that there was some definite parallels there in terms of, again, these were tools that helped increase the likelihood of success for startup founders.
I tease you sometimes about being the unelected mayor of Utah, that you're just so well connected and so well respected in the community. How did you get to be kind of at the nexus of that really early stage founder community? What started that?
Oh man, and I don't know that's totally true, but I do love working with early stage founders, and part of that just came from the passion with the startup ecosystem. I think Carta played a big role in that because I got to know a lot of the founders,
Sure.
and also a lot of the venture capital firms, and it was kind of a natural fit. But even before that, the networking and how I came across Carta was through LinkedIn, and just kind of, connecting with folks there in the space, getting interested in the space, and seeing if there are ways that I could potentially add value. A lot of it came through making connections, and so that's probably the biggest piece is just being able to kind of share your network with others.
Was there a catalyst to starting Founders and Funders?
There was at some level because, for Carta, I was, trying to get in front of founders, and we were also serving venture capital firms. And I remember Brianne, Rochelle, and I, we started just doing these Top Golf events. So we'd go to Top Golf, bring, invite some founders, invite some investors, and we started doing that really regularly. At one point, it was like every single Friday. That's what we'd do, and we'd invite different people every time. So that started to kind of build the formation of what Founders and Funders would become. But I think the real catalyst was during Silicon Slopes, which is the big Utah, tech conference.
Their annual event?
Their big annual event. And I remember this was probably 5 years ago. I was trying to get Carta to be a sponsor. And they're like, yeah, it's way too expensive. And so I was like, well, how can we do something around Silicon Slopes? And so we started putting together, there's a group that we kind of gathered, and we started putting together a happy hour event. We just kind of planned it out. We got a few sponsors to kind of kick in, and this event, it just turned out amazing. Everybody loved it. And so that was kind of the catalyst to say, hey, could we bring founders and investors together in environments like this more often? And so then it kind of led into, hey, maybe we could do like ski events.
Well, I know I'm a huge fan of your Ski with the VC gatherings of solitude. That's I think I've made some of my best founder friendships with going up and doing laps with folks. Yeah. Because I just love that 10-minute chairlift meeting that you're having. And
oh, totally. It's so natural.
It really is. And it's, we've been blessed. Almost every time we go, you seem to, the snow gods smile on us and we have a powder day.
We've had some good days, that's for sure. Yeah, always appreciate your support and help in those events.
Always a pleasure. You also have another company that you created many years ago, Startup Stack. You want to tell us a little bit about that?
Yeah. Yeah, it seems to all be related, doesn't it?
It does.
Common denominator with startups.
Well, you've designed a life where everything's highly complementary.
Yes, that has been intentional.
Yeah.
So, Startup Stack, kind of formed very similarly. There were a few folks that I got to know while I was at Carta, and they were doing partnerships. And one of the things I saw a lot of founders struggle with was, they didn't know, first off, what tools would be helpful for them. They didn't even know tools like Carta were available, for one thing, when I started. And so just kind of education there. But then I also saw them paying for these tools when I knew that Carta, for example, had a free plan.
Right.
But they were, the sales guy's not going to tell you that you've got a free plan when you're ready to pay. And so I was like, well, they have no idea that they can actually get this for free if they go through one of our partners.
Right.
And then I looked at, I was talking to some of the others that were partnership leaders in the space, and they said the same thing. They said, yeah, most startup founders don't realize you can get 10 free seats at Dialpad, or you can get all of these free things because these companies want to be your provider early on because they know eventually if you succeed, you're going to stick with them.
And the frugality that a new founder needs, their time and attention is spread so thin
Totally. Yeah, they can't go research all this out. And I mean, if they don't know, they don't know. Their attorney tells them to go get Carta, for example. And they're like, okay. They get on the phone. They're like, okay, how much is it? All right, my attorney said I need it. They're not even asking about discounts or that. Now, on the frugal side, sometimes they'll do just the opposite and go, yeah, we can't afford that. And so then they forego having some of these tools that they could get for free. And so just kind of that education, being able to know, have one place where startups could go and say, what are the deals that we can, and what are the tools and the deals that are available to us as early stage startup founders?
Truly.
And that became the startup stack.
And now we'll switch to Forecastr. So you joined a few years ago as their head of business development.
Yep.
And I was just recently checking out the website. It has matured and come a long way. There's a ton of templates, a ton of functionality. Would it maybe talk a little bit about the journey and the maturation of the platform over the last 3 years?
Yeah.
With an eye towards, kind of like as an angel investor looking outside in, how it matured from a couple of guys that had done the fractional CFO job and said, we can do this with software, to where it's going today. Can you talk a little, maybe not so much the inside stories, but just how that has matured from idea to a fairly robust platform?
Yeah, it's been fascinating. Because early on, when Stephen and Logan, they're the founders, when they approached me, I knew the story of, hey, we're going to become the Carta of financial modeling, right? Sounded awesome. They were talking about all these integrations at the time. We're going to integrate with QuickBooks and Xero and all these accounting systems, and that took a long time. The product wasn't at a spot where it was super easy to map everything at the early days. And so, early on, our target was, hey, give us a try and we'll help you through it. The one thing that I loved to see about how the company was run is that anytime a customer would leave Forecastr, Stephen, the CEO, would get on the phone and say, hey, really appreciate your business. Saw you left. We just wanted to understand, what would have made the experience better. And he had an exit interview with every customer. And I'm like, okay, this is a CEO that gets it. He is trying to figure out, what will make the product better, what becomes useful. He's doing this customer discovery, for every customer on both sides, on the front end of what would be good for a new customer, in order to sell it. But on the back end saying, why did it not work for you? And how can we improve it so, you'll come back, or, we won't run into this issue in the future. And I've seen that iteration happen over and over again at Forecastr, and that's been the evolution of the platform, where it started out as a, probably kind of a clunky platform that, has gotten to the point where it's very easy to use now.
Sure.
So, and again, that's been through customer discovery and just some great leadership in the company. So I'll also mention, we're actually, this is an ongoing process. We just yesterday had a team gathering where the development team showed us the new Forecastr 2.0 version, and the functionality that they're adding in is really next level. It kind of takes things to this next level, and it's perfect timing because we're in the middle of a fundraise, and we've got some fresh capital that we'll be able to deploy at some point here, and so we feel like we're in a great spot to really take things to the next level and even serve more startups.
That's great.
And beyond.
Well, I think that dovetails into a concept that I put together a few years ago, which was, from a CFO's perspective, the 4 pillars for startup success. And to think of those as having clean books, and again, for a little background, Momentum Finance is a fractional CFO. We're an advisory firm. We have the accounting, the bookkeeping, the strategic advisement. We charge hourly, and so we kind of give a full stack finance team to a founder, and they consume what they need and don't have to pay for the full breadth of excellence or expertise that's required, I would say, but they can get in a bite-sized piece. And I think what Forecastr is doing is softwareizing a lot of what we do and making it accessible and easy. And to step back, I've come up with these four pillars that make sense to me. Is one is having those clean books, which is as simple as a standard chart of accounts. Because I think when we see a lot of pitch decks and we find a lot of opportunity to provide feedback to founders, and when they give us their projections, a lot of times you kind of see revenue or income and then expenses and then the bottom line with no departmental breakout, and it kind of does them a disservice because you don't understand the levers
of your business
in the model.
Yeah.
And so, but you can't build a good, cogent, forward-looking set of numbers unless you have really clean historical numbers.
Exactly.
So you've got the clean books, and then you have a bottom-up driven financial model, which is everybody understands conceptually what that means. But I think we all know we have seen founders' spreadsheets that are either color-coded or just kind of seat of the pants, build it based on the best assumptions they can make.
Yep.
But it doesn't look professional. And so they kind of get a demerit because of the aesthetics of the model when they've made defensible solutions, but it's not presented professionally.
Yeah.
I guess another piece of this is really having the right team. So, having the right individuals in the right seats, which is not only credibility for are these people able to execute on this brilliant idea, but what's the timing of adding to this team? And so this comes full circle to, I always joke that the financial projections is really the business plan in numbers.
Totally.
And so you want to see that set of numbers. You want to see the timing of the assumptions, and you want to see the order of magnitude. And then another piece, which I think is less considered, is finding the perfect investors. And because, when you get investors in a startup, it's a bit of a marriage. These people aren't going anywhere, and you've got probably a 5-10 year relationship. And so
or more.
Yeah. So I guess putting that out there, what are some of your thoughts? I don't know if you have any stories about investments that you've made that you can kind of point to some of these pillars, or what are your thoughts there?
Well, I'll tell you, one of the things I see, and your background is in finance, and I mean you've got this amazing background, so you understand this, and it's really easy for you to go in and look at a financial model or to build that out and understand the financial projections and story of the company. Most founders struggle with that. They struggle with telling their financial story, in a language that investors understand. And so that's where I see, one of those pillars is, to be able to tell your story in that financial model. And you're really trying to tell it in the language that investors understand. And that is typically the language of finance. And so you kind of have to know that language. And I have seen founders get tripped up on that. Investors aren't going to expect a founder to necessarily be the finance guru and, to have, they can hire people for some of that. But they will expect them to speak the language of startup finance, right? If you're pitching to investors and you've got a second meeting, you start going through your financials and they ask you what your ACV is or your CAC or your MRR, and you start stumbling like, I don't even know what that is. That's not a good sign, right? And so I think that's something that as a founder, you do have to know certain things. You have to know your numbers going into an investment round or when you start speaking to investors. But even more than that, knowing your numbers, you can now start to make better decisions. So when you've got that operating model, like you said,
Truly.
Now you have something to measure against to say, how are we doing? Here's our scorecard. How did we do last month? If you don't have that, then how do you know if the business is going well, other than you might see your cash coming in? You're like, oh, we're doing great. but you're not forecasting, or you're not looking ahead saying that, hey, we've got a potential cash shortfall in month 3 or month 6 or month 9, whenever it is. And that can be a real problem when you're trying to raise capital, and you've got 3 months of runway. And that's a lot different than when you've got 9 months of runway. So I think just that is definitely a mistake, or a challenge that a lot of founders run into, is just not being on top of their numbers.
Yeah, I think one of the things that I've seen with a lot of founders is they don't really enjoy the process of playing with the financial projections.
Yeah.
And maybe they want to outsource that. And to your point, at the end of the day, it's their numbers. They provided the guidance for the assumptions that are leading on both the revenue growth and the way they're spending money to, generate that growth, the sales and marketing, the investments on building the software, assuming we're talking about a SaaS company, kind of that, the dollars spent associated with that roadmap to roll that out. And then to your point, tracking that down to EBITDA or cash flow to understand, how that bellwether is kind of flowing through. Because one of the things that at Momentum Finance we're most proud of is that budget versus actual reporting that we provide monthly.
Yeah.
And I think that there's a level of uniqueness that we can do because it is a manual process. But you get a lot of that with Forecastr because you're just putting that stuff in, and because it auto updates once it's configured correctly with QuickBooks,
right,
you automatically generate that budget versus actual reporting. And it's really informative because you want the founder to almost internalize that and feel that information.
Yeah, it's so true. And there's two sides of that. There's one, being able to know those, what your variance analysis is as an operator. You'll be a better operator because you're going to know your numbers. You're going to say, oh, we missed this number last month. Is this a trend, or was it a one-time anomaly? But you're going to be able to dig into things like that. You're going to understand your business so much better. But then when you apply it to fundraising as well, those are some of the things that investors want to see. And you mentioned that is one of the things that's kind of nice about having a software platform is you can pull that data in from your accounting and have that come into a report that you can send out to investors on a regular basis. So if they want monthly, if you want to really impress your investors, send them a monthly variance analysis report. And I know sometimes founders get scared about that. It's like, oh man, do we want to show them all this? But honestly, if you can be transparent with your investors, they can help you ahead of time instead of, we're going to run out of cash in 3 months.
Right.
But if you can have your investors be proactive with you, now you can kind of plan ahead. And so having those monthly or quarterly reports that, can really show the trends or where you're at. I mean, it's going to come back to bite you if you're not sharing it with them anyway. So if they can help out. Yeah,
like you said, there's a lot of opportunity for people to proactively engage.
Right.
And one of wherever their domain expertise is. I mean, I met with a gentleman yesterday that's basically a fractional CRO, and he was explaining that many startups misinterpret product market fit when they have a couple of customers. And what his point was, until you have almost a scientific approach to, meeting someone, talking about the story, giving them a demo, getting a pilot, signing a long-term contract, until that's really a rinse and repeat process, you shouldn't consider yourself as having achieved product market fit.
Right.
You've just, figured out a way to build a relationship with somebody, will contract with you. But until you kind of have a dumbed down, simplified process that's repeatable, you shouldn't consider product market fit as having been achieved.
Yeah, I think that's a great point. In fact, even when you think you have product market fit, I think it's good to revisit that and say, is it still resonating? Because markets change, right? And
markets change. Your software matures. Competitors rear their head.
Yep.
So there's tons of things that you got to be constantly aware of. When you're doing partnerships for a startup, is there is it ever too early? Because I've seen Forecastr has really done a great job, and it feels like in the last 6 months the caliber of the partners has leveled up because you've probably gotten more critical mass.
Yeah.
They perceive that, and then you have a lot of, maybe not global, but national brands that are partnering with you that weren't you were not mutually in the same conversation 6 months ago, but you are now.
Right.
Any insights into what that the crawl, walk, run process is from a biz dev perspective?
Yeah, that's an interesting question, and I have to kind of start looking backwards a little bit and say, what was this like? But what you mentioned, is it too early? Is it ever too early to start partnerships? I'll say, so one of the things that was a real advantage for Forecastr was Stephen and Logan went through Techstars. This was Stephen's second time through Techstars. And through that Techstars network, they started to build these relationships. Well, as Forecastr came out of Techstars, Stephen did a phenomenal job at building additional relationships with Techstars companies, because now Techstars is on your cap table, right?
Right.
There's some incentive built in to say, hey, could we help you, get some other customers or introduce you to other companies going through? Well, building that relationship was right from the beginning. The Techstars companies were like, they became our raving fans. It's like, hey, we're also a Techstars company. Hey, let's try each other's services or whatever.
Right.
Those partnerships started to really run. And that's where I think Forecastr, this was before my time at Forecastr, but stepping into it and seeing what they had already built with that, that relationship in particular, it would suggest it's never too early. I mean, they built their business early on off of partnerships.
Is there maybe some do's or don'ts on how to leverage those early relationships when it's almost more morale boosting than incredible traction? Is there a way to talk about those relationships that maybe founders can get some ideas on how to be productive when they're just those early days in the trenches?
I think part of it is people want to work with people that they like, know, and trust. You hear that all the time. But, I think Stephen was really likable, and there was that easy bond to create with other founders. You're kind of going through, and fortunately, he was selling into founders. So there was that commonality. And I think building relationships is probably the key there. It is very relationship oriented. They could probably go to somebody that maybe even has a better solution than you right now, but they're willing to kind of give you a shot. And then the way you treat them going forward says a lot, because now you can, especially when it's a partnership, you want to make sure every customer that comes through from a partnership is treated, just phenomenally well, because they're risking their brand sending it to you.
Right.
And so that becomes like a real key. And again, one of the things we kept hearing when in the early days was, even if the software wasn't perfect, the experience for the customers was phenomenal.
And that was primarily the customer support, the client success?
Yeah. So, we kind of tied on an analyst that would help them go through the software process, and they would get a white glove VIP, onboarding, and they still do to this day. But, that became kind of a relationship that would get built there. And so, is that 100% scalable at everything you're doing early on? Maybe not, but you get better and better at it, and it becomes scalable.
Well, that's what, other people's money's for, right? Is to kind of leverage so you can lean into these relationships. And just like Uber, I think at one point people were complaining the prices were going up, and it was like, the VCs are no longer underwriting your ride.
Yes, right.
And so, again, this kind of comes full circle back to understanding your numbers, because you're pricing something that aspirationally will be an incredibly profitable company, but today the margins might be thin or even negative.
Yeah.
But you're going to grow through that.
Yeah, and let me give you another example that was really fascinating to see with Forecastr. So one of the things we looked at is, and I think every startup founder could kind of learn a lesson here, but looking at, we started to bring on a lot of customers. So we'd get tons of customers, but they were super early stage, and we were not charging very much. Just get them in the door, and then now we were taking good care of them. But then what we found was that there were certain customers that we'd add more value to, and we consistently heard, it's like, I feel like I'm kind of stealing from you. I mean, I'm getting all this, and I'm only paying this amount. And so we started to run some models. That's what we do. Right. It's like, what would happen if we would it be better to double our subscriber base and keep the pricing the same? Or would it be better to double our pricing and maybe not have as many customers?
Sure.
And start weeding out. And running these different scenarios, you have to have a financial model to do this, right? It's like, what would happen over the next 3 years if we made a price change? And this was a price change, and here are some of the assumptions behind what would happen. And just by doing that exercise, it became a clear choice of what would be the better outcome.
Did you find that, maybe it's the wrong word, but the limitations of this service being softwareized constrained the applicable industries? Is that, I mean, that maybe that's a very different way of saying what you were just explaining. Did you identify that there's a pretty precise set of industries where you go narrow and deep and you're much more productive?
Yeah, I could see where that could be the case in a lot of companies. Identify like a beachhead market or something right. You can really be the expert in and that. In Forecastr's case, I think one of the competitive advantages is that it is very flexible in terms of what you can do with it. So I get asked all the time, so this is just for SaaS companies, right? I was like, no. Oh, can you do CPG companies, like consumer products? And, what about like biotech and stuff where it's a totally different model? Right. And the answer is yes. We've got like a bunch of different models we can even, start out with. But even if it's building it up from the ground, you can still do it. So similar to something you'd do, it's like there's probably not, any company that you couldn't build a financial model for. But if you have the right tools and you've gone through that process before, then we really can serve pretty much any industry. And then even broader, we've had a lot of companies from outside of the United States. So globally, especially with some of our bigger partners now, we're servicing companies from all over the world, which was kind of unique because in my early days at Carta, one of the big restrictions was if you're not a Delaware C Corp and you're if you're in the UK, there are some different rules and regulations, and at the time, it was tough to sell right. internationally. Financial modeling, it's like, oh, so you're doing this in yen? Okay, we can totally do that. It's not that big of a deal. So,
yeah, because I think that when I'm building a model, one of the things that I focus on is there's two custom tabs. The revenue is different because you're building that bottom-up driven revenue. At some point you're still going to have 2 or 3, kind of recurring, non-recurring services, other, maybe some tweak if there's physical goods involved. Yeah. And somehow you're bottom-up building that so that you get to those standard categories that then goes to another tab in the model, and then your cost of goods sold. Is custom. Those are kind of the two primary things that are custom to every individual company. Everything else, pretty standard because, there's only 4 departments for the most part, right? You've kind of got your cost of goods, cost of sales, sales and marketing, R&D, G&A. Every company on the planet has to fit their team into those 4 departments. And it sounds like that's a...
Yeah, it's interesting because the revenue model is probably the trickiest and the hardest to project and do all that because there's a lot of assumptions that have to go into that. But I get asked all the time, it's like, well, can you do like biotech? What about pre-revenue? Like a lot of times biotech is pre-revenue for
10
years, right? It's like, well, Yeah, that's pretty simple because you don't have to worry about the revenue model. You're worried about your costs, right? You're just projecting out your costs and not
got a
rocket
little
science.
G&A and mostly R&D.
Yeah.
Yeah.
Yeah. But you still have to report. I mean, the investors want to know what you're doing with the money and what you're projecting to do with it. And so it's still critical, even though you don't really have that revenue aspect of it yet.
Sure. Have you any high level guidance you give for when, let's assume the hard work's been done in the cave, as it were, by the founders and their team and getting useful projections? How do you recommend presenting those? Because we have a lot of exposure in, the pitch world with, that paper napkin to pre-Series A founders. What is your pattern recognition towards the most credible way to maybe present the financials?
So the one mistake I do see a lot of founders make is they'll either leave out their financial projections, which is very common and which is crazy, because you're going to get asked about it, and so you better be prepared. But then the flip side is giving too much information. In a pitch, I think founders forget sometimes that the purpose of your pitch is to get a second meeting. It's not to sell them that, this is every detail and I'm going to, explain every single detail to you here. And so here's our financial model on the screen. That's not the time or the place. What you do want to show is that you understand the key levers of your business. So what matters? What are the key metrics that, that really matter to this business? And can you show whether it's a trend or traction or whatever? I think what investors are kind of looking for in general is where your mind is at as a founder. So are you thinking that, in 5 years from now, you're going to be a $10 million company or a $100 million company? Big difference. And, as an angel, I might be okay with a $10 million company if it, you've got profits in there and it's like, hey, this could start kicking off some profits for me or be an acquisition target or whatever. But a VC is probably going to look at that and go, yeah, that's just not a big enough bet for us to make a dent. And so realizing who your audience is when you're presenting your financials, but then realizing where your revenue is coming. I mean, early on, investors are interested in, okay, what's the opportunity here? Have you demonstrated there is some traction, or do you have indications that would suggest here's some type of a revenue pattern, because that's going to establish the product market fit, right?
Truly.
And that's kind of what you're looking for is, can we get to this next level of revenue that's kind of proven out product market fit?
Yeah, you want to see those milestones or those proof points along the road to make sure they're going in the right direction.
Exactly.
And I think one of the pieces where everybody knows projections are made up.
Yep.
Okay? So no founder should pretend they actually can have a worthwhile crystal ball.
No.
But what we as a CFO want to project is there's some thoughtful assumptions that we're bottom up building to support what we're doing. And if it's too far out, there is a swag. There's a scientific approach to this guess.
Yep.
And it's defensible. Because what I always tell founders is, good idea, every good idea is worth $1 million. Every penny above that is execution related. And so you're trying to demonstrate that you're the right person, that you've got the right team to execute on this great idea.
Yeah, 100%.
We see a lot of pitches. Founders and Funders is a really nice thing because they tend to alternate the pitch competitions with the reverse pitches to help create that really good founder-investor fit. Do you have any additional thoughts on, what should a rational founder expect in that cap raising process, and how do they potentially find founders that are aligned with them and will be good supporting actors
On the investment side?
Yeah.
Yeah, I think one thing that founders ought to realize is that fundraising's hard. I mean, you're asking somebody to take a chance on you, and so you've got to have a compelling story, just to get out there. But also, just looking at, very few companies. I mean, it's less than 1% are a good fit for venture capital. Right. And I think too many founders think, oh well. That's what I want to do. I want to go down the venture capital treadmill, right? And, realizing that that's not the only path, that there's some real benefit to bootstrapping a company and getting it profitable, depending on what your objectives are as a founder, right? If your intent is not to be the next Google or, whatever company, then it probably doesn't make sense to be raising venture capital. There's some other ways you can do this. So knowing who those investors are, and a lot of times angel investors are more flexible than a venture capital firm might be, if you've got a real good plan in place. So
yeah, I had that conversation a lot with founders recently about the pitch deck that I recommend for presenting to an angel group is not radically different, but is different than the pitch deck that you're sending to a venture capitalist. One of the things that I'm pretty much consistent on banging the drum on is for an angel presentation, the first and last slide should be the ask, and I see the like four quadrants. The ask slide is the offer, so it's I want to raise $1 million, I want it to say 20% discount, $5 million. Pre-post money, whatever it is, whatever's appropriate. Then share the summary cap table. I want to know who owns how much. And then I want to see use of proceeds. What are you spending the money on?
Yep.
And then your contact info. And that should be the first and the last slide. Because as an angel, I want to see, why am I paying attention to this?
Right.
And then as the last slide, it should be the thing I'm staring at during Q&A.
I love that approach because that's what the discussion's going to be around, right?
Totally.
So I love that you kind of back that up as well. Yeah, I think it's interesting that a lot of founders, and when it comes to that ask slide, you do have to know how much you need to raise. And it kind of circles back to your financial projections, right? And being able to back that up. So I've seen founders come in or end their pitches saying, sometimes they won't even mention it. So like the angels are like, so how much?
So why are you here?
Yeah, why are you here? Exactly. And the common response is, well, we're thinking of raising, $1 to $2 million. And you're like, well, is it one or is it two? It's like, do you even need to know what you're going to use it for? But if you can come in and say, we need, $1.3 million, it gets us to here. This is what it's going to be spent on. These are the things. In fact, what I've seen done really well is to say, here's the name of the developer that we are going to hire. We've already interviewed them, and we need them and this other person, and this is what they cost, and this will get us here, and then we have to hire this person. I mean, they've got it all mapped out,
right.
And your trust level goes way up with a founder that has kind of mapped out what the use of funds is, and if they can talk to that, it goes well. I mean, it goes a lot better than when they're just throwing out numbers that it's like, yeah, we think we need about that much.
Yeah, and especially when you have a radically different environment now than it was 2 years ago. Valuations are coming down. The availability of money eventually will peter out because a lot of these folks that have money will not be raising new funds. And, to separate, again, the difference with angel investors is a good, healthy relationship with a certain group of angels. You can kind of tranche it, as opposed to going to raise that $1.5 million. Maybe everybody just kind of works together, and you do it $250,000 or $500,000 at a time, and that people feel more comfortable with that.
Yeah.
The founder also, if they're executing well, they can, baby step that valuation up with each tranche. And so it kind of de-risks it for everybody.
And one thing I've seen you work with founders this way. And because a lot of times, especially if it's their first time through, like going through the fundraising process, to have somebody that's been through it and kind of coach them through things like that. Because a lot of times, I mean, I've seen you do this with founders saying, do you really need $1.5 million today? What if you had $500,000? What would you do with it? And where would it get you? And would that make more sense? And sometimes it might not, but forcing those questions to say, why do you need this amount, and what's the best path to get there?
Yeah, I think it's one of the questions that's really most valuable when you're talking about raising capital is, what does each dollar get you? And are there chunks of it that really radically improve enterprise value? And, trying to back into that.
Yeah.
Because, again, raising a chunk of money to have 18, 24 months runway, there's a different trajectory. Because I think a lot of the founders that we meet, they're totally going to create a 10 million, 50 million enterprise value of a company in X number of years, but that's about it.
Yeah.
And I think that's one of the things that I like about the Utah ecosystem is we have just as many of those companies as we have swinging for the fences, aspiring unicorns.
Yeah.
And economic development is, the American way is these small businesses.
Yeah, you're right. And again, a VC might not invest in that type of a company because it's not going to be a $1 billion company, right?
Yeah.
But realizing that up front and being able to, go to angel investors or other sources should be an option. So,
yeah, I think, again, there's the opportunity is identify your angels to help you get started. And once you get a little bit of traction, go to the family offices. There's just a lot of opportunities that make more sense than, knocking on the door for, the tier 1 VCs.
Yeah.
Well, Jeff, thank you so much for your time today.
Well, this has been awesome. It's always fun to talk to you,
yeah.
Especially about this stuff.
And any final thoughts? Any advice you want to give to founders around why they want to make sure they put their best foot forward on their financials?
Man. One thing I do always, mention to startup founders is, it is helpful to have professionals in areas where you're weak. And a lot of times I'll tie that back to like your attorney.
Right.
Like have an experienced startup attorney that knows what they're doing. And have that early on, even if you're just running stuff past them, and really, really critical. And a lot of times, Tim, I'll see you do this where you'll review like a term sheet or something for a founder. That becomes so valuable because, you've done this hundreds of times. And, you've seen thousands of term sheets. As a founder, you haven't. You probably have seen a handful, or maybe this is brand new to you. So leverage experts that have been through the process, and I think, you do have to pay a little bit, but it's well worth it. One, it's going to protect you, especially on the attorney side, but it's also going to increase your likelihood of being successful.
Truly. Awesome, Jeff. Thank you.
Thank you, Tim.